what in the end, considering some of the leads, was a pretty disappointing session.
A very disappointing session, James, for the Aussie share market. I mean, a lot of the markets overnight seeing record highs. The Nasdaq saw a record high, the German DAX saw a record high. But here on the Australian market, despite the very strong lead from the US market, which was up almost 1% overnight, our market down 0.2%. Some disappointing capex numbers released during the session, but also we've also seen in China some very disappointing numbers as well. If we have a look at Shanghai's composite, the Shanghai composite, it's down 2.6%, and we're also seeing the Hong Kong market down 1.9%. What we're seeing there is an impact from margin tightening by some of the brokers over there who are worried about how fast and far the Chinese market has run. So it does look like worries about a bubble, seeing some margin tightening. That's having an impact on the Chinese market, and some of that may be flowing on to the Australian market as well. But altogether, a pretty disappointing day. Our market down 0.2% when we saw some great leads coming into the session.
Why do you think more broadly than some of the reasons you've mentioned, that there is this underlying pessimism in regards to our own market?
I guess if we have a look at the Aussie share market, we are in the process of a pullback, and most traders would hope that on the 20th of May we saw that low at 4,576 points. But altogether, the weakness that we've seen in the last couple of sessions probably does point to more volatility on the market to come. Also, just in relation to the weakness that we are seeing in China, some of that tightness and the tightening of margins and the raising of margins could be having an impact on the Australian market as some of the Chinese investors look to liquidate some of their holdings to bring up more capital for margining if that's what's required by their brokers. So a bit of weakness around a lot of stocks on the market, especially in the banking space, looking oversold on the Aussie market. So I wouldn't be surprised if we did see a rebound over the last couple of weeks. It has been quite a dramatic fall. For example, Commonwealth Bank saw a high of $96 and then a low of $82 within a matter of months. So it has been quite a steep decline for a lot of the stocks on this share market, but the performance on the market today really quite disappointing.
A catalyst to move the market higher over the longer term?
I think energy will be quite volatile. We are seeing the oil price still at relatively low levels at the moment, but I think it's more of a trading area rather than investment area as well at the moment, because it isn't quite clear where prices are going to be, and we are seeing still quite a bit of volatility there. I guess if we have a look at what's driving the markets, I don't think it's really been the fundamentals that has been driving the markets for a while now. What it has been are some of the key macro factors, like the huge amount of liquidity being pumped into the market, as we've seen from the US, as we are seeing from China, as we are seeing from Europe, as we are seeing from Japan. So these are the type of markets that are likely to perform. There hasn't been much of a connect between markets and economic performance as such. If you look at China, some of the worst economic performance that we've seen in a couple of decades, and yet its share market the highest level that we've seen since 2008. And even if you have a look at after the global financial crisis, the US economy wasn't doing so well, the share market continued to climb. So the massive amounts of liquidity that we are seeing around the globe really having a huge impact on asset prices, and I think that's a number one consideration for investors. Secondly, the fact that the banks haven't been driven by fundamentals for a while. I mean, they've been some of the most expensive investments in the world, the most expensive banks in the world as well, and they've been driven by bond prices. So continuing to watch the bond market, and despite fundamentals having to kick in at some point after the global financial crisis, it really has been more of a liquidity game, watching bond prices and interest rate expectations, which have driven investments.
Off the back of the capex number, a weakness in the Aussie dollar. Your own view on what's been, I suppose, around for a while, that this strategy of buying those offshore exposed earnings stocks?
Sure. I think the Aussie dollar isn't being so much driven by domestic factors as much as it's being driven by what's happening in the US. And as the US economy strengthens, then we are going to see the US dollar strengthening against the whole basket of global currencies. And I think that's why the Aussie dollar is going to be weaker, not so much because of commodities demand bouncing back, but more because of that US dollar story. We have a look at those US dollar exposed stocks, or the currency sensitive stocks. They've done extremely well. Just in 2015, Macquarie up by 38%. We've seen QBE Insurance up by 30%, Ansell up by 20%. So some big gains there, but the Aussie dollar, medium to long term, still probably in that downward trend, because we're probably looking at a multi-year upward trend for the US dollar, and that's going to mean weakness in the Aussie currency. So I think that has more to play out. So a little bit different from Michael's call there. Also, those countries and economies still issuing liquidity, like Japan, like Europe, I think will continue to outperform, and investors can get access to those areas through exchange traded products, which are listed on the ASX and have been performing quite well.
All right, on that note,